In this video, we're going to be talking about a couple of graphs that are contrarian indicators that say a different story. Now, normally, when retail investors go into the stock market and they find a specific stock that they love, a lot of biasism starts to percolate up and they say, well, my stock's the best. And they get attached. You know, it's okay. They get emotionally attached, which, I've honestly gotten emotionally attached in my years to a specific company. It's like, I like this company. But the problem is that when they're faced with a other investment thesis, retail investors, they tend to label it, especially now. They tend to label it as FUD, fear, uncertainty, and doubt. The other person's stupid. They're shorting the market, X, Y, and Z, and there's no trust. Now, if you graph that with the level of distrust in the American community in regarding to politics, you might see a correlation. I don't know, correlation does not equal causation, but it may work in the political system because the economy keeps going, fingers crossed, and people's lives are not affected. But if you think like that in the stock market, you will be wrecked. You'll be creamed. You'll be annihilated. You'll be destroyed. So I hope you got the point. So we're going to go ahead and build this up. So back on January 28 of 2022, I said that Apple stock is a hold. It's a darling stock, right? But my price targets are anywhere between $54 to $96. When I first published this back on January, our members at Our Stock Alerts were like, hey, what's going on? Are you sure? You know what I mean? Well, the thing is, Apple, people trust it. It's almost like a it's like a high interest savings account for people. That offers a dividends and that gives a return. So that's what people think of it as, which I don't really think is smart. But from the creation of this back on January 28th, the stock was trading at $170. In fact, it was over 180 at some time point. Now it's at 136. In fact, if you take the difference, it dropped $33 since the time of posting that All Stock Alerts, and it dropped approximately 20%. Same thing with Apple. We said, well, Apple's overvalued. It's anywhere between 143 to 273 with the bull, from the bear to the bull. Right now, we said this on January 28th at $308. It was near almost $350, right? $349.67 was the all-time high. And if you look at it now, it dropped $51, approximately 16% plus. So, back on Apple, the Apple was high was 182, and I already mentioned that, but I just wanted to preface this. So as you can see, in the market, there's some stocks that are overvalued, right? So the question you have to ask yourself is well, are all stocks like that? Are all stocks overvalued? Should I just not go into it? And the problem is most people don't know how to evaluate a company and set a price target. All right, I'm not talking drawing resistance lines and constellation stars and putting some tea leaves on it and watching a couple videos and voila. I'm actually talking about fundamental analysis, real fundamental analysis, actually finding the intrinsic value of a stock. The question is, how do you do that? Well, we're going to be talking about it. So going back, right now, from based off of these calculations, and this is basically, this takes a standard deviation approach. In this video, we won't be discussing that. If you want me to talk about this, let me know. I have taught statistics and also economics. So if you guys want an academic discussion about standard deviation, we'll definitely do that. But think of this as resistant lines. The further you get away from it, the lower the probability on both ends, right? Both when it's high and when it's low, from the stock price, right? So right now, at the level we're currently in, we're at very overvalued. We did cross deeply overvalued. Remember when the fusion frenzy in January of 2021, when stocks go up, when peak YouTube and meme stupidity was at its peak, terrible. But we're slowly descending down to the fair value, or possibly we'll be bouncing off of the overvalue region. We don't know, but I will tell you here, if we do go down to these levels on the very undervalued scale, we can see that there's a strong preface at around this resistance level, if you may. So definitely keep an eye on this. It's nice to try to work with stocks and go back and forth between this location and possibly near this location. And if you do this, you tend to do really well, right? So if you haven't done so, please subscribe, and we'll keep you updated as the market goes on. So going into these projection models, And what this does is it basically takes the S&P with dividends and it extends it out until 2023 and beyond. And what it does is it goes over two different types of probability scenarios. The high, which is in the middle. The purple line is where we're at. So if you go back before the pandemic, the market was getting to a point where it started becoming overvalued. If you remember, the Federal Reserve started to doing the easing, and they started to lower the interest rates. Not too much, but they started to, the economy, Trump basically threatening the Federal Reserve, Jerome Powell. It was the wild, wild west. But when the pandemic happened, we shifted down below. The Federal Reserve changed its course because the whole economy shut down. It would have been worse, and people would have been dying if they didn't do anything. And then the market became extremely overvalued. So now we're reverting back to the mean. Now we could go right in the middle between this. We'll keep you updated. But the thing is, you can't just use one image. You gotta, we have like hundreds of things that I look at to kind of assess the picture and glue everything together to form a holistic understanding. Okay. Now, if you look at this contrarian indicator, when stocks go down, it's bullish. When stocks go up, it's bearish. You might be like, what? The thing is, retail investors like it when stocks go up. They think this is bullish and this is bearish. And that's the stupidity of retail investors. So I hope, you understanding this, you watching this now, you're like ahead of the game right now, okay? So the question is, how do you evaluate a company? Like how do you find the intrinsic value of a stock? Well, you see me do it all the time. So it's no doubt that I'm going to be sharing with you that you got to find a way to, do this by looking at the intrinsic value, looking at a value and knowing how to basically look for the free cash flow and know how to project out in a company. It's almost more of an art than a science, but you need to understand the science of it too, the math. You need to understand and have a price to projected sales calculator by looking at the price of sales from the growth perspective, right? We go ahead and have the book value calculator and the intrinsic sell calculator, where it basically tells you the current stock. Should you sell it for the new stock? And if so, in terms of the capital gains tax you're going to pay, which is going to outperform, the current stock or the new stock? And sometimes the current stock, it's better just to hold, right, versus the new stock. But hey, if you go in and basically switch, it'll graph you. It'll say, hey, maybe the new stock will be better, right? And then you want to, look at the new stock, and you want to look at the book value, dividends, return on equity, current ratio, debt to equity ratio. A lot of analysis happens, guys, when you analyze the markets. So, this is why we created this whole OWL Stock Alerts and Mastering Stock Market course. If you want access to all of our intrinsic value calculations, also lifetime access to option flows, dark pool data, our proprietary software that basically gets data, literally 30 years of financial data, and gives you a set of equations, about 30 to 50 equations, so you are able to analyze on, have a sophisticated understanding of the market. In the link down below, we do have access to our Mastering Stock Market course with an expiring coupon code. We have been featured on Bloomberg Market Watch, NASDAQ, Benzinga, Yahoo Finance, Yahoo Money, and so many other platforms because our product works and our members are doing really well. It is a privilege and honor to serve you guys. And if you did enjoy this video, please go ahead and like, subscribe, and comment and share. I will see you on the next one.